All right. The Foreign Tax Compliance Act, FATCA, which brought some of you here today because you got letters from either Alpha Bank or Ethniki or Piraeus Bank or something saying, please come in and identify yourself as a U.S. person, either because your Greek passport shows you're born in Boston or you've otherwise advised them that you're a U.S. citizen. FATCA was enacted by Congress in 2010 to address primarily tax evasion by U.S. citizens using foreign bank accounts. Congress didn't take into account the millions of U.S. citizens living outside the United States who are using foreign bank accounts for ordinary banking purposes. It took a twofold approach: the individual disclosure required on Form 8938 and foreign financial institutions' requirement to report on U.S. accounts to the IRS. Dealing first with the individual mandate, if you have, and we'll go through it in a couple of seconds, certain foreign financial assets of a certain value, you have to file a Form 8938 with your U.S. tax return. Congress didn't replace the FBAR. It simply added an FBAR-like document to your requirements and put it on the tax return. So you still have to file the FBAR. You may or may not have to file FATCA. Anybody who has to file FATCA is going to have obviously filed FBAR because the filing thresholds are quite different. Form must be filed with the U.S. tax return, and it was first required with your 2011 U.S. tax return. So if you filed a U.S. tax return for 2011 and you haven't disclosed foreign income on that return, and you didn't file a Form 8938 with that return, then you're going to be filing under the SFOP to correct both errors. Okay. Your filing status and your residence governs the filing thresholds. So, filing status. If you're single or married filing separately and you live outside the United States, the total value of all foreign financial assets, and we'll get to those in a minute, exceeds $200,000, again, this is all equivalent to $200,000, on the last day of the year, or $300,000 at any time during the year. So those two numbers, if you're single or you're married filing separately, and your aggregate foreign financial assets at the end of the year are $200,000, or at any time during the year exceeded $300,000, you have to file the form. It's an either-or test. If you're married filing jointly and you're living outside the United States, the total value of your foreign financial assets is essentially double, $400,000 on the last day of the year, or $600,000 at any time during the year. The amounts are much lower for U.S. persons living in the United States. It's $75,000 for single persons and $150,000 for married couples filing jointly. Accounts at foreign financial institutions defined broadly to include insurance companies, private equity funds, and other investment entities and vehicles not commonly thought of as financial institutions. We think of banks primarily as financial institutions. We don't think about, for example, mutual funds, or we don't think about insurance companies as being financial institutions. But under FATCA, they are. It clearly includes all bank accounts of all kinds. Some other little hidden gems. Stock in foreign companies held through a foreign financial institution. So, for example, if you have a stock trading account, that would be included as a foreign financial account. Stock in private foreign companies. You and three partners have created a Greek business. You've incorporated it as an SA, and you have 30%. You're a U.S. person. The other people are not, and you have 30% of the shares. You have to report the value of those shares on your 8938. You and a couple of partners have created an OE under Greek law, which for U.S. tax purposes is a partnership. You're a 40% partner in that partnership. You have to report the value of your 40% interest in the OE on your 8938. the value of foreign mutual funds, and probably not a big item on your list, precious metals held indirectly through exchange-traded funds. Foreign financial assets do not include personal property such as artwork, precious metals, jewelry, real estate held directly. Now, let me explain that just a real quick bit here. If you and 2 or 3 friends have gotten together and created an SA to become a developer in Greece, and you've acquired several properties, and you now own them through an SA, that the value of your shares in that SA is reportable under the private corporation. If you and your friends own it personally, that is, you go in as a joint venture, for example, and we own it in the names of Yanni, Theodore, and Katrina, then that's not reportable. So any real estate you own personally in your own name, either you jointly with others, is not reportable as a foreign financial asset. Social benefits provided by foreign governors are not considered foreign financial assets. What are the failure to file penalties? Well, there's a $10,000 penalty immediately if you don't file the form. There's an additional $10,000 penalty if it's not filed within 90 days of being notified of an initial penalty. At the end of the day, the total could equal $60,000 for failing to file the form.